The Fatter Wallet Show is where faith meets finance and wisdom shapes work. Our mission here is to explore how timeless principles of stewardship, wealth, and purpose can radically transform the way you live and build your legacy.
That's the heart of it, really.
Yeah.
In every conversation, we aim to provide insight, practical strategies too, addressing those real-world challenges around money, business, and mindset. Our goal is simple: help you grow in wisdom and wealth, following financial principles rooted firmly in faith and purpose.
And today we're tackling, well, maybe the most essential lesson in all of financial life. It's one that should really humble us all. The core lesson is this: doing well with your money. It has astonishingly little to do with how high your IQ is.
Right.
It's almost everything to do with the decisions you make, your behavior. Behavior, those quiet daily habits, that's the silent, dominating driver of financial outcomes.
It really is.
To illustrate this, I have an anecdote. It just lays the complexity bare.
Mm-hmm.
We're talking about a technology executive, okay? A certifiable genius who, in his early 20s, designed and patented a key component used in Wi-Fi routers globally.
Wow. So massive intelligence, early success, instant wealth, you'd think.
You'd assume this man was set for life, but his relationship with money, it was toxic. A volatile mix of deep insecurity and, frankly, profound emotional immaturity. He wasn't just spending, he was performing.
That's fascinating. What did that performance look like? Because, true wealth often seeks anonymity, right?
Yeah.
But insecurity, it always needs an audience.
Well, it showed up in these spectacular displays of almost disregard for money. He would routinely carry massive stacks of $100 bills. I mean, sometimes inches thick.
Just flashing around.
Openly flashing them around. But here's the most bizarre example. He once handed a hotel colleague thousands of dollars in cash, told them to buy gold coins.
Gold coins.
And then he gathered a small group by the Pacific Ocean, and they proceeded to skip the gold coins like flat stones across the water.
No.
Yes! Laughing as they watched thousands of dollars in tangible assets just sink into the deep. It was flaunting, taken to an absurd, almost theatrical degree.
Wow. Throwing away precious metals just to show you. Okay, that screams less about wealth and more about, desperation for recognition. It's the ego writing checks the wallet.
Yeah.
Even a really fat one can't possibly cover forever.
Exactly.
So what happened? What happened to the genius who thought gold coins were disposable skipping stones?
Years later, I learned the predictable, but still tragic conclusion. That wildly successful, brilliant executive, he went completely broke.
Oh, no.
He was a technological architect, no doubt, but a financial toddler. He lacked that fundamental control over his emotions and the necessary understanding of, faithful stewardship to preserve what his brilliance had earned him.
That story, that executive,
Yeah.
it's the perfect setup, really, for our first major theme.
Yeah.
Contrasting the folly of that kind of ego with the extraordinary power of simple, almost mundane financial behavior.
Yeah.
If you judged purely on intellect or, educational achievement, that executive should have been set for life.
But financial reality often just defies the Ivy League diploma, doesn't it? We want to pivot now to the story of a man whose life was the polar opposite of that executive, Ronald Read.
Ronald Read, yeah.
If you ever look up his story, his professional history is summed up as janitor, gas station attendant, and investor. A simple man from rural Vermont.
In Read's life, it was defined by consistency, right?
Wow.
Not flash. He was actually the first in his family to graduate high school.
That's right.
Worked at a gas station for 25 years.
Yeah.
Then swept floors at a local JCPenney for another 17 years. The total income from these jobs, well, it wasn't high by any standard.
Not at all. When he was 38, he bought a small 2-bedroom house for $12,000, lived there for the rest of his long life. His hobbies weren't exotic travel or luxury cars.
Right.
They involved chopping firewood and collecting stamps.
Very grounded.
Yet when he passed away in 2014 at the age of 92, this humble janitor made international headlines. Why?
Because he died with a net worth over $8 million.
$8 million. And he left the majority of that fortune millions to his local hospital and his local library.
It's incredible. And the profound lesson here is in the how, isn't it? There was no inheritance, no sudden IPO windfall, no high-risk venture capital play.
None of that.
Read simply saved what he could every single month and invested those savings consistently in blue-chip dividend-paying stocks for decades.
That's it. That's the whole story.
It's the extraordinary result of applying very ordinary financial skills, but with incredible patience and immense time. He wasn't smarter than the Harvard executive. He was just more patient, More humble,
It's
maybe.
definitely more humble. And if we want the ultimate contrast, let's bring back that archetype of the high-achieving elite, Richard Fuscone.
Ah, yes, Fuscone. Harvard-educated, Merrill Lynch executive, MBA,
Yeah.
retired early to pursue, life on his terms. He embodied that traditional idea of financial success and shrewd business savvy.
Look like it on the outside.
But here's the kicker. Just 5 months before Ronald Reagan's humble, quiet fortune was being distributed to charity, Richard Fuscone's lavish Greenwich mansion, the one with that infamous see-through dance floor over the indoor pool,
Oh, I remember reading about that.
it was sold in a foreclosure auction for pennies on the dollar.
You just have to sit with that comparison for a second. The janitor who waited, who was content with enough, finished a wealthy man and a massive philanthropist.
Yeah.
The Harvard executive, driven by that pursuit of perpetual more, that public display, ended in ruin. In what other field could this possibly happen? You can't become a leading cardiac surgeon just through sheer patience and reading books, right? You need intellect, training.
Exactly. But in finance, the soft skill discipline, emotional control, how you behave, it's fundamentally more important than the hard skill of knowledge. It's really a study in psychology.
It is.
The difference between Reed and Fuscone wasn't intellect. Reed was governed by humility and consistency. Fuscone, driven by greed and status.
And this realization brings us to such a crucial point about humility and empathy in stewardship. Recognizing why financial behavior varies so widely among people. We're often so quick to judge others' choices.
Oh, absolutely.
But we fail to account for the fact that people operate on lessons learned from their unique personal experiences, things that shape them.
That's behavioral anchoring right there.
Yeah.
Imagine someone who lived through the Great Depression, or maybe grew up during periods of just crippling hyperinflation.
Yeah.
That experience fundamentally anchors their view of cash, of debt, of risk. They will think about savings and bonds in a way that someone who only knows stable prices and low interest rates. They just can't truly fathom it. Those emotional scars, they dictate behavior years, even decades later.
And this is the core reason our financial beliefs become so rigid, isn't it? Your own personal financial experiences, the era you grew up in, the first job you had, the first market crash you lived through, that tiny, tiny sliver of world history anchors about 80% of how you perceive the financial world works today. It creates these powerful, often subconscious biases.
Yeah, think about, say, a generational bond manager like Bill Gross. His extraordinary career coincided almost perfectly with a sustained, decades-long collapse in interest rates. To him, bonds were wealth generators, low-risk assets that returned consistently well.
Made sense from his viewpoint.
But if you talk to his father's generation, who saw high inflation and interest rate volatility, they might view bonds as wealth incinerators. Their personal timelines dictate their risk tolerance, not just the current yield on a spreadsheet.
Which requires immense humility from us. When we look at seemingly poor decisions other people make, we have to pause the judgment. Think about the lottery ticket example.
Ah, yeah, that's a good one.
Many Americans, often in the lowest income demographics, spend hundreds of dollars a year on the lottery. To an educated, high-income saver, this looks like, well, blowing their safety net on terrible odds. Mathematically irrational.
It does look that way on the surface, but we need to look deeper, at the behavioral economics. If you strain to understand their perspective, maybe they aren't paying for the mathematical odds of hitting it big.
What are they paying for them?
They're paying for the hope. If you feel trapped in absolute economic constraints, where saving one extra dollar feels negligible compared to the mountain you have to climb, that tiny cost of a ticket provides a temporary, tangible moment. They hold the ticket and imagine the liberation that maybe you already take for granted.
That's a powerful perspective. The math of misery. It means that $10 isn't going to fundamentally change their life situation through saving. But the dream they buy with that $10, maybe that's worth the emotional price to them.
Exactly. They might feel they've already given up on escaping poverty through conventional saving, so their decisions become reasonable within the context of their constraints, even if they aren't strictly rational on a spreadsheet.
We have to recognize that financial choices are just deeply rooted in personal history, pride, sometimes ego, not just pure logic. That humility, that understanding, that's the starting point for effective stewardship, isn't it?
Absolutely.
Yeah.
And if the previous discussion was about the necessity of patience, our next theme really centers on the spiritual anchor of contentment defining enough. Because we live in a society that's expertly engineered to generate both wealth and envy simultaneously. It's a toxic combination.
It really is. And that potent mix leads us straight to the danger of the moving goalpost, right? That insatiable appetite for more that just disconnects us from purpose, from spiritual grounding. You never feel satisfied because the moment you achieve one goal,
You see someone else's bigger goal.
exactly, you need to conquer that next. I always come back to that perfect story of Joseph Heller, the novelist.
Oh, the party story.
Yeah. He was at a party hosted by a billionaire hedge fund manager. Someone pointed out to Heller that the host had made more money in a single day than Heller had earned from his masterpiece, Catch-22, over its entire history.
Ouch.
And Heller's perfect, witty response was, "Yes, but I have something he will never have. Enough." That concept, finding enough, it's not about stagnation. It's about defining success internally, rooted in purpose, rather than always looking externally.
And failure to define it. Well, it can be catastrophic. We see it in those case studies of professional ruin. Take Rajat Gupta, for example, former CEO of McKinsey, arguably the most prestigious consulting firm in the world. He was reportedly worth over $100 million.
An almost unimaginable sum. Provides security for generations. Yet, he risked his stellar reputation, his personal freedom, for the mere chance of becoming a billionaire. Led directly to insider trading charges, prison time.
Just astounding. And look at Bernie Madoff. Before the infamous Ponzi scheme, Madoff ran a massively successful, completely legitimate market-making business. Yeah. Made him tens of millions, legally, every single year. He had wealth, prestige, security.
Both men threw away their entire lives, their reputations, their freedom. Why? Because they fundamentally lacked a sense of enough. Their ambition just increased faster than their satisfaction. It accelerated their risk-taking.
And once you're playing at that level, as the material we looked at points out, there's absolutely no logical reason to risk what you have, what you desperately need, for something you don't have and truly don't need. It's the ultimate financial hubris.
Yeah.
The problem is just stoked by the social comparison trap. It is a battle designed never to be won because the ceiling is infinitely high and it's always moving. You can compare your salary to a high-earning doctor, sure. Then you realize that doctor's earnings are dwarfed by a hedge fund manager pulling in $770 million in a single year. The pool of people who earn more than you is practically endless. It never stops.
And that leads to such a crucial realization for the steward. The only way to win the comparison game is to completely opt out of the fight. Contentment is an active choice. It has to be rooted in your purpose, not just passive acceptance of scarcity. We have to establish enough based on our needs, our mission, our calling, not on our peers' rapidly accumulating stuff.
That's it. That spiritual inability to deny a potential extra dollar. It will eventually catch up to you, whether it's crippling debt, unnecessary risk, or even moral failure.
So when we talk about purpose, we have to identify the highest form of wealth. What's the ultimate freedom dividend that money can buy?
Well, wealth's greatest intrinsic value isn't buying more things. It's buying control over your life, specifically control over your time.
Exactly. And the research strongly confirms this, a strong sense of autonomy, that control over one's life. It's actually a more consistent predictor of overall happiness and well-being than just having a high salary or driving a fancy car or even having a huge house. Money is a tool, its best use, managing volatility and increasing your agency.
Think about the practical application of that. When you have a cash buffer, even a small one, you gain independence. An emergency savings account means you aren't terrified of a difficult boss because you know you have the option to walk away without immediate financial ruin.
Huge difference in mindset.
The 6-month buffer means you can wait for the right opportunity after a layoff, rather than feeling forced to take the first stressful, maybe soul-crushing job that comes along.
Or think about the choice between two jobs. One pays, say, 20% more, but it requires 60 hours a week and an impossible commute. The other pays less, but offers flexible hours, allowing you to prioritize family or service or just breathing room.
Right. That money, used wisely, buys independence and flexibility. As the material pointed out, doing something you actually love but on a schedule you can't control. Well, that can feel exactly the same as doing something you hate. Money's true power is unlocking your schedule.
It makes so much sense.
And this is why, when mentors or researchers interview elderly Americans about their life lessons, there's such a consistent theme. They universally value quality relationships, unstructured time with family, and living a life of purpose, far more than they value maximizing their income or raw purchasing power.
They get it by them.
They realize that controlling your time, your life's most finite resource, is the most valuable dividend money can possibly pay.
Okay, so shifting gears a bit. When we talk about growing wealth responsibly, we absolutely must talk about compounding. Compounding is truly the engine of good stewardship over the long haul. But its secret is profoundly non-intuitive. The real secret isn't brilliance, it's simply time.
And there's no better example of this than Warren Buffett. We often focus on his incredible stock-picking skill, right? But his fortune is overwhelmingly tied to two, maybe less glamorous factors.
Yeah.
The tiny financial base he started building way back in his adolescent years.
Like age 10 or something.
Yeah, incredibly young. And the sheer longevity he maintained, investing consistently from that young age well into his late 80s.
So let's run that scenario you mentioned. If Buffett had started his successful investment journey at a much more normal age, say 30, and then retired at age 60, like many people do, even if he achieved the same extraordinary 22% annual returns during that 30-year period,
His net worth today would be, well, drastically, massively smaller. In fact, the calculation shows it would be over 99.9% less than his actual current fortune.
99.9% less. That missing 99.9%. That's the power of those early years and the long tail of just sticking with it. Longevity.
That massive difference really proves why compounding is so difficult for the human mind to grasp. We are wired for linear thinking. Addition, 2 plus 2 equals 4. Easy.
Simple.
Exponential thinking, where the gains start earning their own gains.
Yeah.
That's hard. We tend to focus all our energy on trying to maximize the returns this year, maybe chasing the hot stock or the high-risk venture.
Yeah, the quick win.
But the truth for the wise steward is that a successful long-term financial life is less about earning the absolute highest returns in any one year and much more about earning good, reasonable returns that you can actually stick with and repeat for the longest period of time possible. Consistency applied over decades. That's the financial equivalent of a nuclear reactor.
That's a great analogy. And this leads us directly to the crucial difference between getting wealthy and staying wealthy. Getting money often requires a dose of risk-taking, dynamism, long-term optimism. You have to believe your idea, your venture, will work.
You need that drive. But keeping money, that requires the exact opposite temperament for survival. It requires deep humility and honestly cold paranoia, that constant fear that what you've built can be taken away just as fast, maybe faster.
We see the tragic cost of lacking that humility in historical figures like Jesse Livermore, maybe the greatest stock trader of the early 20th century.
A legend, yeah.
He had an unfathomable moment of genius, maybe luck too, when he correctly shorted the 1929 market crash, accumulated a fortune equivalent to more than $3 billion in today's money in a single day.
Incredible timing.
But overflowing with the confidence from that success, he became convinced he was untouchable. He started taking larger and larger, more reckless bets, convinced he could predict every next turn.
Right.
He lost everything, went deep into debt, and tragically took his own life. Livermore was brilliant at getting wealthy, absolute brilliant, but profoundly terrible at the humble defensive task of staying wealthy. He survived the crash, but failed the subsequent test of humility.
So stewardship, therefore, is fundamentally about survival. Michael Moritz, the head of the famed venture capital firm Sequoia Capital, he credits their decades of success, not just to sheer brilliance or always spotting the next unicorn. He attributes it to always being afraid of going out of business. They operate with the assumption that tomorrow's economic climate will be hostile.
That's the mindset.
That survival mindset is paramount for compounding to work its magic. If you get wiped out, or if you're forced to sell everything during a panic market downturn, you reset the clock. Back to zero. The ability to just stick around for a long time to endure the crises, that's what creates the massive difference between, say, $11 million and $120 billion. Longevity wins the game.
So building a financial life that truly reflects good stewardship, it means focusing intensely on being financially unbreakable. We have to adopt that survival mindset over a growth-at-all-costs mentality.
Planning is, of course, vital. We all need a plan. But the most important part of every single financial plan is recognizing and then structurally preparing for the certainty that the plan will not go according to plan.
Right. Things happen.
Think about just the last few decades. Who had 9/11 in their forecast? The global financial crisis, a global pandemic, sudden births of hyperinflation. A good plan has to be resilient enough to absorb these inevitable shocks without completely collapsing.
This really changes how we need to view cash, doesn't it? Holding cash in a bull market, it feels boring, counterproductive even. Maybe it's yielding only 1% or 2%. It feels like you're missing out on big gains.
It does feel that way, but If holding that cash prevents you from having to sell your growth assets like stocks or real estate during a deep bear market panic when prices are slashed 30%, 40%, maybe more,
Hmm.
then the true return on that cash is massive.
Explain that. How is the return massive?
Because avoiding just one desperate, ill-timed sale during chaos can do more for your lifetime wealth accumulation than years and years of small, consistent market gains. That cash, while it seems lazy, acts as a volatility hedge, a stabilizing force. Its function isn't primarily to generate returns. Its function is to preserve your other investments and keep you in the game long enough for them to recover and grow.
That makes sense. It's like insurance. This concept is known as the margin of safety, right? An idea borrowed from Benjamin Graham, the father of value investing.
Exactly. And it's not just about being conservative for the sake of it. It's about increasing the odds of survival at any given level of risk you're taking elsewhere. Graham famously said that the purpose of a margin of safety is to render the forecast unnecessary.
I like that. Render the forecast unnecessary.
You don't have to know exactly what the market will do next if you have a wide enough cushion, a margin of error to absorb pretty much any shock that comes your way.
So the necessary financial mindset, then, it requires a kind of psychological balancing act. You called it a barbelled personality.
Yeah, that's the term used. You have to maintain long-term optimism. That's the faith and belief that the economic arc generally bends toward growth and prosperity over time, that things will eventually work out for the good.
Okay, the optimistic side.
But, and this is crucial, you must pair that faith and optimism with short-term paranoia. The absolute certainty that the path between today and that prosperous future is filled with unforeseen landmines, volatile crises, unexpected setbacks.
So they're not contradictions. Optimism and paranoia?
Not at all. They are complementary survival tools for the faithful steward. Look again at the long history of the U.S. economy. Over 170 years, it grew 20-fold, an incredible sustained success story, right?
Amazing growth.
But that progress happened despite 9 major wars, 33 recessions, assassinations, countless market collapses, pandemics. Progress is not linear or peaceful. It happens amid chaos.
That's a sobering thought.
And this is precisely why short-term paranoia is essential. It keeps you alive, liquid, positioned long enough to benefit from the long-term faith that the system, guided by time and ingenuity and maybe providence, generally works. Survival is the absolute key to activating that compounding miracle.
Okay, so let's nail down one more crucial distinction. It's about being rich versus being truly wealthy. We often mix these up.
We do. Being rich is often about high current income. It's visible. It's often spent. Think the person driving the brand new fancy sports car. It's an easy label for us to apply from the outside.
Right. We see the spending.
Wealth, conversely, is hidden. It is income not spent. It's the accumulation of financial assets, stocks, bonds, real estate equity representing an option not yet taken. Its true value lies in the flexibility it offers, the control it provides over your future time. True wealth tends to be silent.
And here is the central paradox we talked about earlier. When most people say they want to be a millionaire, what they actually mean is they'd like to be able to spend $1 million or live like someone who earns $1 million a year.
Which is the literal opposite of being wealthy.
Exactly. Spending money is the opposite of accumulating wealth. Wealth accumulation requires that profoundly difficult discipline of not spending the money you have, or at least not spending all of it.
And this is where faithful stewardship meets personal humility again. A high savings rate is far more important for building long-term wealth than even a high income, because wealth is fundamentally relative to what you need to live.
Explain that relativity.
Well, if you earn extraordinary investment returns, say 8% annually, but your lifestyle inflates and compounds just as fast as your assets do, you're actually worse off, or at least no better off, than the person earning a simple 4% return who is highly efficient and humble with their spending habits.
That's powerful. The insight is stark then. A high savings rate is defined by the gap between your ego and your income. Once your basic needs are met, spending beyond a reasonably low threshold of materialism, it's primarily a reflection of ego seeking validation from the outside world.
So, logically, to increase your savings rate, you must fundamentally learn to raise your humility, lower your need for that external validation through consumption.
That's a spiritual discipline as much as a financial one.
Absolutely. Furthermore, savings shouldn't solely be earmarked for specific goals. The down payment, the new car, the retirement account. Those are important, yes. But a wise steward should also save just for the sake of saving. Savings without an immediate spending goal attached. That's the ultimate hedge against life's inevitable surprises.
Like the field mice.
Exactly like the field mice. Remember that analogy from World War II? One of the biggest unexpected logistical hurdles for the German military wasn't Allied bombing raids. It was tiny field mice chewing through the insulation of electrical cables on their tanks during transport and storage in the winter. Caused unexpected failures far from the front lines. Who plans for field mice? Nobody.
Right. Unpredictable.
That's what non-goal specific savings are. They are your defense against the financial equivalent of the field mouse. They provide this powerful, intangible value. Options, flexibility, the ability to wait for a storm to pass, the crucial time to think clearly when chaos strikes. That control over time is far more valuable and more capable of increasing your actual well-being than any tangible item money can buy.
Okay, finally, we need to recognize the difference between what is strictly rational and what is profoundly reasonable. Academic finance, spreadsheets. They always favor the mathematically optimal strategy, the rational choice.
Right, the numbers say do X.
But in the real world, we're human beings. We're emotional stewards managing real lives involving spouses, maybe coworkers, families. We have doubts. We need a strategy that maximizes how well we sleep at night, a strategy we can actually stick with through thick and thin. That is the reasonable approach.
And we even see this with the experts. Look at Harry Markowitz, the Nobel laureate, who essentially developed modern portfolio theory, the mathematical basis for so much investing strategy.
The godfather of diversification.
Exactly. When asked how he invested his own money, he admitted he just split his personal portfolio 50-50 between stocks and bonds. Now, this was almost certainly not the mathematically optimal allocation, according to his own complex theories.
So why did he do it?
He said he did it simply to minimize future regret. He chose a reasonable strategy that maximized his personal comfort and peace of mind over the technically rational, maybe slightly higher returning, but potentially more volatile one.
And that's the wisdom we really need to impart, isn't it? Investing involves not just math, but emotion, relationships, self-doubt, a strategy that is technically imperfect, maybe slightly suboptimal on paper, but one you genuinely love, believe in, and can tolerate through those steep market corrections.
Whether that's highly diversified index funds or a specific real estate focus you understand well or something else.
That strategy will ultimately be far more successful for you. Why? Because you will stick with it during the inevitable lean years. And we return again to that primary point. Longevity wins. Sticking with a reasonable plan beats jumping between theoretically perfect plans you can't stomach.
Well said.
We've covered a lot of ground today, but I think the synthesis is pretty clear. Financial success. It's largely a behavioral science, not particle physics. You have to focus on your behavior over trying to be the smartest person in the room.
Right. And understand that enough is defined by your purpose and contentment, not by endless comparison with your peers or neighbors.
You must faithfully leverage that non-intuitive, patient power of time and compounding. Let it work for you.
And finally, build your financial life to be unbreakable. Through humility, through preparing for surprises, through having a significant margin of safety.
And remember this above all else. While we share these, what we believe are universal truths of stewardship, financial advice must always be personalized. There is no single mathematically right answer that works for everyone.
No silver bullet. There is only the answer that works for you and your family, the strategy that helps you minimize emotional and financial regret and maximizes your independence and your ability to fulfill your God-given purpose.
So the final piece of wisdom to leave you with is this. The ability to live wisely and build wealth isn't achieved by somehow avoiding all mistakes or maximizing every single dollar in the short term. That's impossible.
It's really about structuring your financial life with humility and endurance, so that when the inevitable crises or failures arrive, the market collapses, the job is lost, life throws that curveball, you have the necessary margin of safety to remain standing.
And that endurance allows God-given time to transform those small, consistent, humble efforts into extraordinary, purposeful results over the long run. If you enjoyed today's discussion, be sure to subscribe and visit fatterdwallets.com for more content, resources, and tools to help you live wisely and build wealth with purpose.